mean, when you're starting a business, there are several different ways to fund it. And a lot of times it depends on what your goals are, long term. And I think for some, self-funding it is ideal. You cede no control. You manage your growth usually in a very considered method. There's debt. You're not giving up any portion of your company, but you still owe somebody and you have to pay them back. And then there's of course the venture world, which is trading some of your ownership stake in the company in exchange for cash to help grow it and hopefully multiply the value of your business and now your new investors portion of the business as well. And what we saw with Truman's was an opportunity to fast track what's really been kind of a slow transformation of the category. And when you think about our, the shift to e-commerce across any number of categories over the last 20 years has been pretty rapid, from not existing really basically in the mid 90s to, you think about all the things you buy online today. And cleaning really never caught up with that. And a lot of it is because of upstream issues with the supply chain. They're making these big plastic bright containers that are filled primarily with water. And that works when you're selling them on big pallets and you're putting them on a shelf and you're trying to get attention. And then you start adding more and more options. Well, what we saw was an opportunity to, attack the space, frankly, really rapidly, because there are ways to deliver cleaning products that are e-commerce first, that are with sustainability in mind and with customer experience in mind. And so we saw an opportunity to kind of strike while the iron was hot. Let's take advantage of this. And so for us, we knew we were going to take outside investment so we could put the kind of money towards growth that, would be difficult to bootstrap and self-fund. Then when you make that decision, I think it's, okay, whose money are we going to take? Because we're now bringing them in as co-owners of the company in a way. And, you can get into varying levels of control, different types of options. So basically you want to evaluate, how much of your company you're willing to give up and who you're. And for us, we saw opportunities with Henkel, as you mentioned, not just with a check, but with industry expertise and know-how. We've had tremendous access to data on the industry that's helped guide some of our decision makings, consumer trends and whatnot. And also just capabilities from, an R&D standpoint, from a supply chain standpoint and procurement power, and even just from connections. So they're a global company and, we're not in retail today, but they do business with virtually every retailer, globally. And so it's optionality for you when you're partnered with somebody like that. Now investors typically have opportunities too, if they're institutional investors versus a strategic, in that, they have portfolio companies and connections that they can link you with. So at the end of the day, you're sitting down and they're selling as much as you're selling in some circumstances, because you want to make sure it's a good fit in both directions. And so it was a really interesting experience and we took our time with it. We had our first conversations shortly after we launched. So shortly after we talked, we had our first sit-down meetings in May, and then we didn't close the round until September. So we definitely took our time and got to know some different folks, and we were really happy with the investment team that ended up closing our seed round.